Hey, good evening, everyone. Marty Missouri here, 14th of October, 2022, with your weekly economic update. No stock market snapshot on this one. I think the one we did earlier today more than suffices for the moment. Clients in particular, if you didn't get a chance to watch that one, please do. Take the 15 minutes or so when you have the time and get under the surface a bit in terms of what's driving the market. I put kind of what the Fed's doing today versus government debt, inflation, and so forth into some historical context that I think is very important as we think about constraints on the Fed going forward. We talk about our 3,500 target on the S&P getting hit yesterday, what's changed since we originally kind of staked that area out, what the odds are or the likelihood is of that holding going forward. And so a lot there in 15 minutes that I think is valuable if you're thinking much about the equity market today. So as for this presentation, though, our PWA economic index rose a little bit, 2 points, week over week, to round it up to -7, ninth week in a row below zero. That suggests that recession odds exceed continued expansion odds in the months to come. That's our base case, although our base case is also that we will have, by historical standards, a relatively mild recession based on the world as we see it today, always, of course, subject to change. The handful of inputs I want to share with you this evening, we'll start with retail sales. Core, which X's out food and energy, jumped by 0.35% month over month. Headline, which includes food and energy, up 8.2% year over year, flat month over month. Interesting thing about the year-over-year number is it matches CPI, which came out yesterday for the year-over-year number. And so these are nominally expressed, so they're not adjusted for inflation. So what that says is we really saw zero real growth when it comes to retail sales year over year. Consumer confidence, the University of Michigan survey results came out today. I talked about that on the stock market snapshot because the market began to roll over really hard when the report suggested that consumers expect rising inflation 6 months out. And it's been several months now where they've seen inflation declining in terms of expectation. We're in October, gas prices are rising again, and apparently that's showing up here as well. But, it is an improvement overall. Conference boards has been improving a little bit of late as well. Initial jobless claims continue to rise for the second week in a row. So that supposedly is what the Fed is after, is somewhat of a loosening in the labor market. Got a long ways to go. Still a very tight labor market out there. The CPI number, again, 8.2% on the headline, which includes gas and energy, increased on a month over month. This was year over year. This is month over month. X out food and energy, up 6.6 core, up 0.6 on the month over month. Producer price index also came out last week, pretty much flat year over year, pretty good increase on a month over month basis on the headline. Core beginning to roll over. And we are seeing things really begin to roll over in places that may not necessarily show up in these numbers and in the PCE numbers until we get into early next year. And that ultimately is bullish for equities, the way the market is trading these days. The Bloomberg Commodity Index, which captures a basket of commodities, you can see it's just kind of in a range here that I've circled. Up and down, pretty good correction right here, found support right there and kind of bouncing around. Of course, this is an inflationary look. Long term, we do believe we're in the early stages of a long-term bull market in commodities for a variety of reasons that we've expressed here and will continue to reiterate or remind you about as long as that's our thesis going forward. Raw industrial materials are interesting because these aren't traded in the futures market. So these are just priced and what you see is what you get. Very disinflationary move there. Now, again, historically, still a plenty high level, but, it's all about direction and rate of change as we move. So, from a technical perspective, you got a bear flag pattern going on there, and that's pretty much playing out. Probably go a little bit lower here, technically speaking, but yeah. So this is this is the kind of information that ultimately is a weight on the inflation data in the months to come. Copper, this is a real busy chart. I really don't seem to want to get rid of my annotations here because China has a real influence. So you recall I've been tracking the dates and showing them move based on China headlines. So copper's interesting. Technically, it's starting to look kind of compelling to me again. As you can see, we're kind of, I can maybe draw an uptrend line there. We're connecting a few points here, but we're beginning to move back up here. The MACD has a buy signal coming off of oversold conditions on the RSI, or nearly oversold, I should say. And folks, we have the 20th National Congress starting on Sunday, and pretty good bet that China's going to unveil a pretty strong attitude and maybe some details about more stimulus going forward. You could see that have an impact on copper. They still are the biggest consumer of copper in the world, so a lot of what they like to do when they stimulate has to do with infrastructure. So we'll see how that plays out. Maybe the copper price is beginning to anticipate something there. One thing that I got totally wrong, according to the Chinese media, is that I really thought they would be abandoning the zero COVID policy sooner than it looks like they're going to. And that is a headwind for all things Chinese economy, which is the second largest economy in the world. I mentioned this on the other video. I don't want to belabor it here, but it looks like that once they get their antivirals scalable and perhaps a new vaccine, mRNA vaccine scalable, I think that's going to be, that inflection point, so to speak, where you do see them really begin to abandon that policy. The Chinese economy really needs the government to do that. But, digging into it a little deeper, they are very concerned when you look at the size of their population, and even with the Omicron variant, the small percentage who are ending up in the hospital would be huge pressure if you scale that across the Chinese population on the Chinese medical system. So apparently there's more to it than just a communist party trying to control its people, because people in some areas are really beginning to push back, which is very interesting to see in a place like China. So a lot of political pressure there, a lot of economic pressure. Can't help, quite frankly, not everybody's on this page, but I think looking at the levels of Chinese equities and looking at where we sit today and really what the changes are going to be relative to what's been going on in China are all bullish. Probably will look good for our emerging markets exposure, as we get into next year, particularly if the dollar begins to come off the boil, and it is very much on the boil. A lower dollar is going to be very bullish once we get there for our not small foreign equity exposure going forward, and not to mention our commodities exposure going forward as well. And then lastly, consumer staples versus consumer discretionary. When this is going up, consumer staple stocks are outperforming consumer discretionary stocks. Broken down, here's consumer staples, here's consumer discretionary. When staples, right, let's call them the things people got to spend money on if they want to stay alive, outperform the things people spend money on when they got extra money, that is a negative sign for the state of the economy, and it comports with our overall recession thesis. And in a recession, when inflation is rolling over, the Fed then will probably pause their hikes. Don't know that they'd cut unless something really breaks and we have a real deep recession, then they will cut and start doing, quantitative easing as opposed to the quantitative tightening that they're doing. But then as we gather steam and the world kind of opens back up, and we think Europe is essentially in recession now, so they'll come out of it sooner than we will if we go into it, say, in the first quarter of next year. And then ultimately we have, going into the second half of 2023, a pretty good looking setup in what is typically a really good year, which is the third year of the election cycle, coming off of a really bad year so far during this midterm year. So seasonality gets better from here, and now I'm talking about equity markets, between here and the rest of the year, but it doesn't really necessarily have to play out this way. Keep in mind, we're dealing with something that we haven't dealt with in 40 years, and that's inflation at these levels, and a Federal Reserve that seems to be, in real tightening mode. However, if you really pay attention to what they're saying, they are beginning to get concerned about some systemic risk. Janet Yellen, the Treasury Secretary, clearly has made some comments this week that has her concern. We've seen what's happening in the United Kingdom. The Treasury has actually been reaching out to banks, and they're proposing maybe they do some buying back of treasuries to put more liquidity into the market because we're seeing a lack thereof for the Treasury market. Seems to be a fear that something could break in the credit markets. I talked a little bit about that also in the earlier video today, so I think I can kind of stop there. Lots of this developing, folks, and that sort of thing is starting to get their attention. And even in an inflationary environment, if things begin to kind of crack or rupture a bit in those credit markets, you're going to see them act on it. And it's all about, will something break? If it does, there'll be this falling knife. The Fed will try desperately to catch it. Markets will roll over. I was asked a question on the blog. I haven't had a chance to answer it yet. What rolls over? What does good? What does bad? Well, when something breaks like that, all correlations pretty much go to one, meaning everything just kind of moves together. Even the things that like treasuries and gold, like when you look at the COVID rollover break, in the spring of 2020, the October of 2008, everything gets sold off for a while, right? Why? Because things break and you get these margin calls, and you get this panic. People sell what they can get a bid on, and the stuff that like gold, perhaps in treasuries, that's supposed to work real well. That works real well. Therefore, they have a bid. They can actually get something for it. So for a moment, so to speak, when you think of it in the grand scheme of things, when things break, everything kind of breaks with it. But folks, think about what I'm implying there. This is everything kind of breaks with it, and it bottoms, and central banks jump in with all kinds of supports. And what happens, right? You want to be in stuff down there when they begin to come back, especially the good stuff that has good long-term prospects. So I don't know that something's going to break. I've been suggesting that we're beginning to check our boxes, that we may be approaching the bear market bottom. I'll say it once again. I think we are closer to the bottom than we are the top from a time or calendar perspective, and probably, but not guaranteed, but probably also from a level of, major equity averages perspective, particularly if we're going to have just essentially a mild recession. Other things, a resolution in Russia and Ukraine, that would be unambiguously bullish for the economy and for markets. I mentioned the China opening back up situation and so on. So things feel very gloomy out there. Sentiment is very, very gloomy. And then suddenly, as we experienced yesterday, you get whatever, a little bit of sunlight comes through, or maybe just we hit a technical level and we bounce off and we get a bunch of short covering. Suddenly there's this big panic that rushes into the market. Like a lot of people are pointing out, these huge price swings are pretty much only happen during bear markets. I don't disagree with that. Also, as we begin forming that bottom. Now, I don't want you to misinterpret what I'm saying, because I have been saying consistently that we think odds favor that we don't hold that 3,500 level that we originally thought might be where the market holds. We could, and it bounced off of that strong yesterday, and it did not close back down there today. So that's optimistic, but we have the next week and few weeks to get through. We do have this period of strong seasonality, which I think a lot of people are aware of. So it would not surprise me to see a bounce. But I'm hearing people, some very popular financial media figures saying, sell every chance you get next week because this market is going to be ugly and earnings are going to be terrible. Well, it's ironic when we have net down revisions as opposed to net upward revisions. Stocks tend to do well during that earnings season. Again, we're in a bear market. Different rules apply technically and fundamentally. So I'm not making any promises here, but we're just always shorter term and longer term, looking at all possibilities, trying to stay humble and objective. Just day in, day out, it's a grind. Look at the data, look at sentiment, and formulate what we think are good theses and allocate assets in what we think is the optimal risk reward setup, recognizing that on a short-term basis, there's going to be a lot of volatility in anything that we do right here. Folks, I'll leave it there. Hope you have a great weekend. To be back early next week or over the weekend if I think there's something of value that I'd like to share with you. Thank you as always for watching and listening. Talk to you soon. Bye-bye.